Hello, my name is Ian Slattery from Zurich Investments. Firstly, I'd like to thank the team at Alpha Wealth for giving me the opportunity to speak with you today and to give you a bit of an update on terms of investment markets. So what we've seen so far in 2023 and what we might expect to see for the rest of the calendar year. In relation to equity markets overall, if I just bring up the year so far for the US market, the largest equity market globally, and I'm showing you in the blue line, the S&P 500, and in the red line, the NASDAQ index. So you can see if I'm looking from January through to July, that both those red and blue lines have seen positive growth and are very firmly in positive territory for the year so far. This contrasts with what I've shown on the bottom half, which has been poor performance for banking stocks overall. The reason I'm showing it like this is many of you remember the furore, the turmoil that we saw in the banking sector in April and March of this year around Silicon Valley Bank, for example. But what I'm showing you here and why it's important is that the wider equity market has proven to be resilient and that there was no contagion into the wider equity market from some of the problems that we've seen in the banking sector. So very much a poor 2022, the last year for equity markets and risk assets overall, but they have rebounded quite strongly so far in 2023. Another main topic that I'm sure you're all aware of, and it's affecting our daily lives as well as investment markets, is the rises we've seen in interest rates across the developed world. I'm showing you here the key policy rates or interest rates in the US, the Eurozone, the UK, and in Switzerland. And you can see that step change higher that has occurred across these four main monetary areas since 2022. It is interesting to note, though, we looked just 12 months ago, the Eurozone still in negative territory for interest rates. That's the red line, but very much above 3% today in relation to that main interest rate. And this is something that's really, really important when we're looking at risk assets, so equities and bonds and things like that. And it is something as an active manager looking at the top-down process, looking at the economic cycle. It's something that does inform our thinking in Zurich quite a lot. So interest rates are very much in positive territory and very much in positive territory for the foreseeable future is the view from Zurich. In relation to inflation and interest rates and economic growth, what I'm showing you here on the left-hand side of this particular chart is purchasing manager index data. So this is information in terms of where certain industries think that the economy is going in the near future. And the blue line represents the services side of the economy. The red line represents the manufacturing side of the economy. Essentially, anything over a value of 50, the dotted line on the screen represents growth in the economy. Anything below represents a contraction. So you can see the impact or potential impact of those higher interest rates in relation to these lines trending downwards over the last couple of years. So again, there is an indication that the economy is slowing somewhat, perhaps still in positive territory, given that we had such pent-up demand post the COVID lockdowns. However, on the other side, when I'm looking at wage growth with the UK wage growth percentage in the blue line and the Eurozone equivalent in the red line. So wage growth still remains very robust and very strong at the highest levels that we've seen in almost a decade. This suggests that perhaps the economy is still doing very well because employment markets are tight and workers have good negotiation standpoints or bargaining power in relation to higher wages. So there is some conflicting pictures out there in relation to the global economic outlook, and it's something as an active manager that we're always weighing up within Zurich. As I look towards the rest of 2023 for the bulls, so some positive things that could happen in the market. I mentioned that we are seeing a slowing economy. I suppose one positive development could be that a recession is avoided entirely, or if a recession does materialize, that it will be shallower than has been feared over the last 12 months. China, the second biggest economy in the world and soon to be the biggest at some point in the next decade, it's got many policy levers that it can pull in relation to its own economy, which will therefore obviously trickle down into Asia and the wider into developed Western markets as well. There's also been a lot of talk around artificial intelligence, AI, and that has helped boost the stock market overall in 2023, in particular the technology sector. So there's always some potential for positive upside for the bulls, those people who are more bullish in the markets. On the downside, and we're always very cognizant of risks here at Zurich, is inflation could remain unduly sticky. So it hasn't fallen quite as quickly as some commentators may have expected to. And again, inflation does mean rising prices. and it does obviously have an impact on economic growth in relation to interest rates as well. I mentioned interest rates a few times already. There is a risk that central banks over tighten. And what I mean by that is they bring interest rates to too high a level or do higher interest rates too quickly. And that can knock the economy in terms of over tightening and unduly cause a recession. Geopolitics are always a keen concern across markets. We've obviously seen the continuation of the war in Ukraine following the Russian invasion in early 2022, and that continues to weigh on markets and society as a whole. In relation to the overall outlook from Zurich, we do maintain a positive view on risk assets. So we do favor equities, for example, in multi-asset funds, so where we can invest in equities, bonds, and cash. Some of our funds we are favoring equities in those funds. Within equities in general, we do maintain a buy on dip mentality. That means if we saw equity markets fall 5, 6, or 7%, for example, we would see that as an opportunity as opposed to the start of something more negative. In relation to bonds, we do have a regime change. We do believe that's evident in the market as a result of those higher interest rates. And that does actually create further opportunities for active managers such as Zurich. It's been a tough time for bonds over the last 18 months in relation to returns. However, we are now at a level that they are more attractive overall. And finally, commodities, I've already mentioned the geopolitics, in particular in Russia, Ukraine. We've already seen the unraveling of the grain deal in relation to Russia, Ukraine, and Turkey. That puts pressure on commodity prices in terms of soft commodities, whilst we've seen the likes of gas and oil actually come off their highs in recent times as well. So overall, a positive view from Zurich, and we do maintain a positive outlook on markets. However, as active managers, that can always be updated over time. And no doubt Nick, David, and the rest of the team at Alpha Wealth are more than happy to answer any questions you may have in relation to your own investments and pension planning. But thank you very much for your time.